Okay, good morning, everybody, and good afternoon in parts of the country. Greetings from Southern California, where it's supposed to be in excess of 90 degrees today. So hopefully, for those pundits that say the virus will not thrive in the warm weather, we're hoping that that holds some truth out here. Thank you for joining us on this Thursday. For all of you that are not sure, it's a Thursday, and we're really excited about today's program. My name is Tom Michael, and I have the pleasure of being the president-elect of NAFA, and I'm the host for today's program. I want to welcome everybody to this webinar, all NAFA members, but also those that aren't NAFA members, those from the American College, LIMRA, WIFS, LIMRA, and on down the line. So thank you for joining us today. Again, I've alluded to before, I really think you're going to find today's program very timely and very informative. As many of you may or may not know, NAFA, since the world got turned upside down, has been putting on these town halls to try to provide more value to all our constituents. As if you haven't seen, we've been putting these on and putting them back on the web for you. For those of you who are taking notes, if you want to go back to some of these archived, it's belongtonafa.org/town halls. And on those, you'll have the likes of Tom Hegna, Van Mueller, and others who all both alluded to the work that our today's speaker has done in regards to retirement distribution. There in front of you is today's agenda. I'm going to open, and with that, I'm going to pass it over now to our illustrious CEO, Kevin Mayu, to give you a few NAFA updates. He has helped us through calm waters and is now helping us through stormy waters. It's my great pleasure to introduce Mr. Kevin Mayu.
Hi, thanks, Tom, and thanks again for everybody for joining us here today, either live, like a bunch of you are doing right now, or those of you that are going to watch this later in our archive versions later. As Tom mentioned, all of these town halls, we've got them recorded, we've got them archived, and they're really to be a resource to you, our financial security professionals, so that you can access whenever it's convenient for you, and can give you ideas as to, again, how you can make lemons out of lemonade, or make lemonade out of lemon, in this new environment. We've got lots of great stuff out there, and we hope you'll take advantage of it, because that's what NAFA does as your professional association, not only during a crisis like this, but every day, all year round, every year round, and out for the past 130 years. A couple things I just wanted to bring you up to speed on. One, today we're getting out a new Gov update. We expect that to go out as soon as we have final passage of, I guess they're calling it version 3.5, and that's the supplemental funding to add additional money to the Paycheck Protection Program, as well as the EIDL and other relief that's going to our hospitals and first responders. We expect to get that out today to you guys to bring you up to speed with what Congress has done. Second, there's a ton of states that are getting out legislation related to COVID-19. We, of course, as the only real professional association in our space that has a state level presence, we've been able to combine all those resources together. And we've got that listed right there on our advocacy.nafa.org COVID-19 page. So in our resource kit, you can track whatever legislation might be going on in your particular state related to COVID-19. So take advantage of that. A couple more things just to mention for you. Again, the congressional conference got canceled because of this, but again, we are going to sit back and turn it into a virtual event. It's going to take place for 3 days in mid-May, and it's free and open to all financial security professionals. So not just NAFA members, but please, please, please feel free to invite any of your advisor friends to join us as well. Tuesday, May 19th, our Diversity Symposium. Wednesday, May 20th, our Advocacy and Action Day. And then Thursday, May 21st, the Leadership Day. Great programming for you all 3 of those days, all free of charge. And we hope that you'll join us again, because together we can accomplish anything. Back to you, Tom.
Kevin, thank you. And yes, I hope everyone does take advantage of that. And we will have some upcoming town halls that I'll get to at the conclusion of today's presentation. But without further ado, I'd like to introduce today's guest speaker. And again, I've had the pleasure of sharing a stage with him a couple times and listening to him and reading his white paper. So I think you're really in for a treat. Mr. Wade Pfau is a PhD, CFA, and he's a professor of the retirement income in the new PhD program for the financial and retirement planning for the co-director of the New York Life Center for Retirement Income at the American College. And actually, it's not all that new anymore. He's been It's been up and running here for a while. He's a past selectee for the Investment News Power 20 for people expected to shape the financial advisory industry, and he's a recipient of Financial Planning Magazine's Influencer Awards. He's also served, he serves very actively, the curriculum director for the RMA, Retirement Management Analyst Designation Program, and he's really got his feet tied into the RICP, the Retirement Income Certified Professional Program at the American College as we speak. He holds his doctorate in economics from Princeton University, and he's published numerous research papers on retirement planning in a wide variety of academic and practitioner research journals. He's also the author of 2 books. I think you're going to probably hear about one of them today. Safety First Retirement Planning, and then also How to Use Reverse Mortgages to Secure Your Retirement. And in case you didn't see it, just recently, with the market fluctuation, he wrote a great article on how the 4% distribution rule might be a little bit in danger. Before I introduce Wade formally, please, I want to remind you, if you do have questions, we will try to have a Q&A session at the end, but please, at the bottom of your screen, for those of you who are on Zoom, use the Q&A box, not the chat box, the Q&A box for questions for Wade. With that being said, Wade, the floor is yours, and thank you very much for joining us today.
Great. Yeah, thank you, Tom, and thanks everyone for joining. This presentation will just be about what's going on in the markets in terms of how that impacts retirement income planning in today's environment. I am at the American College and the director of our RICP Retirement Income Certified Professional Program. And also, if you'd like to see the information about the spending rates in this presentation, you can find that at my website that's listed up there, retirementresearcher.com. and /join to get a PDF version of that. And so getting into that, the main issues, well, and also for more background, I do have the Safety First Retirement Planning book. But the main issues we're talking about here are significant market losses going on right now, continuing market volatility and uncertainty about what's going to happen with the markets. And also, not to be forgotten in all this, but the historic low interest rates right now are really impacting retirees in a way that's not necessarily the headline, but it's very much a part of what's going on. And so retirement income planning is about developing strategies to manage these risks. Longevity risk is at the top, and it's misnamed in the way that it's this idea of living a long time. But living a long time becomes more expensive. There's more years of the budget that need to be funded, and then there's more opportunity for these other risks to become an issue. And these are macroeconomic and market-related risks. And we have this notion of sequence of returns risk, where when you're taking distributions, the market returns in the early retirement years have a disproportionate impact. And then there's inflation, eating away at the purchasing power of wealth, and then different spending shocks, healthcare events, long-term care bills, and so forth, that just require additional liquidity as well. And about that sequence of returns risk, to really emphasize who's the most risk at what's going on in the financial markets right now, well, would be people that retired this year. This slide is showing over a 60-year period how important is each year's market returns to explaining lifetime financial outcomes. And the idea is people are working and saving for the first 30 years, retiring in year 31, and then enjoying a 30-year long retirement. So the market returns early in one's career and late in one's lifetime don't have that much impact. But it's really right around the retirement date where market returns are having the biggest impact. And especially it's that first year of retirement, that what happens in financial markets during that year for an investment-based retirement strategy are really going to be the key to driving what the outcome for that retirement. Now, when we look at managing these risks, there's just 4 ways to do it. Now, there are subcategories, but any sort of strategy that can be named, I'm pretty sure can fit into one of these 4 categories. And so the options are, you can spend conservatively. And this doesn't necessarily mean with a bond portfolio. This is more the logic of what's known as the 4% rule of thumb, where you essentially figure out how much can you consistently spend with an aggressive portfolio. The 4% rule called for a 50 to 75% stock allocation in retirement. But how low does your spending need to go so that you don't worry about running out of money even in the event that you live a long time and you experience poor market returns. It's not necessarily the most fulfilling way to build a retirement income strategy. So other options: spend flexibly. If you can cut your spending after a market downturn, that can help manage this sequence of returns risk because it avoids having to sell assets as much at a loss. Reduce volatility. Now, this doesn't necessarily mean going into bonds. And in this regard, soon I'm going to show the estimates about sustainable spending with different strategies. You can build a bond ladder and figure out exactly how much you can spend. And then there's not going to be any upside above that. You'll be certain you're going to deplete your asset base at the end of that bond ladder. And if the spending rate implied by that is lower than you had hoped for, reducing volatility is not necessarily going to work for retirement income. Now, strategies that I do mean in this category, well, I don't necessarily view it as a best practice, but in the investment world, this is where all the bucketing strategies would fit. The idea of using bonds for short-term expenses and stocks for longer-term expenses. This is also where I would place the best practice ideas, which are more around incorporating the power of actuarial science with annuities and insurance in terms of the simple income annuity, for example. You get a bond-like return on the underlying asset, but you get to spend more because you also have the mortality credits and risk pooling. Or it could be the variable annuity with a guaranteed living withdrawal benefit attached to it, where you have the volatility for the underlying asset base, but spending is protected from the downside risk because even if markets go down, you have that living benefit protection. And then the fourth approach are buffer assets, something held outside the investment portfolio, not correlated with the portfolio, that can provide a temporary resource for spending after market downturns to help avoid selling portfolio assets at a loss. And at the end of the day, I'm only aware of 3 buffer assets. And the first one, I don't think necessarily works all that well, but it would be the idea of cash. You just have a big pile of cash outside your portfolio. The problem with cash is you have to extract that from your portfolio to create the cash buffer. And then that causes you to need to use a higher distribution rate from what's left in the portfolio. And then when you balance a higher withdrawal rate with the cash buffer, you're not necessarily left in a better position. So the other 2 buffer assets I think can work better. And these are cash value of permanent life insurance and the growing line of credit on a reverse mortgage. They're both resources that don't lose value, and especially in a market downturn. So they can provide that bridge, that temporary spending resource to draw from after a market downturn to avoid selling portfolio assets at a loss. Now, one other point about all this is the low interest rate environment is going to be very important in terms of what I use to determine what are sustainable spending rates today. And I do want to just mention this idea that with annuities, there's this notion that if interest rates are low, it's a bad time to use an annuity. Now, to be clear, that sort of commentary wouldn't apply to a deferred annuity that still gave you the exposure of upside and the ability to not lock in today's yield curve. That would be a claim made more about an immediate annuity, where you would be locking in today's yield curve. But the point is, for people who are at retirement today, low interest rates impact everything. And actually, on a relative basis, annuities are not as impacted as negatively as other investment-based strategies. And so to just understand that point, if I'm going to spend from an investment portfolio in retirement, these are my 3 sources of spending. The principal itself, the interest or dividends, and then this idea of capital gains or the risk premium. The idea that stocks will outperform bonds, it's a big part of that 4% rule logic. 50 to 75% stocks in retirement. And then if markets cooperate, you get to spend more because you're getting those capital gains from the stock market. Well, no matter what you do today, interest rates are low. And so that really eats away at that part of the spending power. And that actually increases sequence of returns risk, because if you're not getting the capital gains, you're more quickly getting pushed into spending principal. And if there's a market downturn, and so a capital loss, you're having to sell a bigger chunk of that principal to cover spending. And that's where then that asset's gone from the portfolio, and the portfolio doesn't have an opportunity to recover. Well, with the annuity, this is where the logic comes into play, is the same notion. Interest rates are lower, and so that interest rate component is less of a factor. The payout rate on the annuity will be lower. But the point is, mortality credits aren't really impacted by interest rates, and so they become relatively more important. And actually, in a low interest rate environment, the case for an annuity becomes stronger. It's not the conventional wisdom that you should avoid annuities in a market down or in a low interest rate environment. If you're retired today, you have to spend. And if you're somehow waiting for interest rates to go up, you're spending down your investments in the meantime. And then maybe interest rates don't ever go up. But even if they do go up, and so the payout rate on the annuity is higher, well, what have the bonds been doing in the meantime? If you're investing for yield, you might have bigger capital losses with the interest rate risk. If you're just holding those bonds in cash, you're missing out on any yield. You may not have the capital losses, but you're spending on those assets. And when you later get to multiply a higher payout rate by a lower remaining asset base, you don't necessarily have more income that way. It's not necessarily worthwhile to wait if you're retired to purchase an annuity. Now, to just emphasize that point again, this is looking at two different ways to fund retirement. I could build a bond ladder through age 100, and this is showing the cost of that for funding $10,000 of real spending power over through age 100. So the purple curve is the cost of funding that at different interest rates. And then the yellow curve is the cost of funding that with an income annuity. And when interest rates are lower, it's true, annuities will cost more. And that's where this notion of don't use an annuity in a low interest rate environment comes from. But the problem is the cost of funding retirement with just bonds grows faster than the cost of funding retirement with an annuity, that the spread increases. At higher interest rates, bonds always cost more than annuities, but the difference between them is less. In low interest rates, the cost grows faster for bonds than for annuities. And so again, the relative case, annuities have a stronger appeal in a low interest rate environment for people who are retired. Now, with that being said, I do want to talk about the current situation of what are sustainable spending rates in today's type of market environment. And so I do this at my website, have this dashboard up where I look at these dedicated income sources, and then we'll look at spending from volatile investment portfolios. And this is based on where the markets were on April 1st for a 65-year-old couple. And I look at three different spending goals: just fixed spending, so no increases over time; spending that builds in a 2% cost of living adjustment, so annual 2% increases in spending; and then spending that adjusts for the consumer price index. And so for that inflation adjusted spending, that has to be based on TIPS, Treasury Inflation Protected Securities, which provide those real yields plus whatever the realized inflation ends up being. And so we can see, well, if I want 30 years of spending, now for a 65-year-old couple today, 30 years isn't so conservative anymore. That would get them to age 95. And they still have the Society of Actuaries data shows over about a 45% chance that at least one member of that couple may still be alive at that point. The bond ladder would fully deplete after 30 years, so it doesn't provide any longevity protection. But those are the spending rates based on where the yield curve was on April 1st. You're looking at about a 3.92% withdrawal rate just with fixed spending. For CPI adjusted spending, a 3.36% withdrawal rate. And then usually you would think that 2% COLA would have a higher payout potential than CPI adjusted. But the issue there is the markets are baking in very low inflation, about 1.15% over the next 30 years. And I didn't change that COLA assumption because I think very few people would be comfortable planning for just a little bit over 1% as the inflation rate over the next 30 years. But that explains why the 2% COLA spending rates come out less here. Now, income annuities offer higher payout rates than bond ladders. And that's going to be true whenever you want the bond ladder to last beyond a life expectancy because of that risk pooling and mortality credits, the subsidies from the short-lived to the long-lived. So you can see with fixed spending, the SPIA for a joint and 100% survivors annuity, close to 5%. For the 2% COLA, it's a 3.73% payout rate. And then this year, we don't have any companies offering the CPI adjusted income annuities. Hopefully someday they'll return again to the market. Now these numbers can be contrasted with the logic of the investments only approach, which is I'm going to self-manage my investment risk and my longevity risk. And I'm just going to determine how much can I sustainably spend where I feel comfortable about not outliving my assets. Now to look at these numbers, I consider 3 different scenarios: conservative individuals, moderate individuals, and aggressive individuals. And whether you're conservative, moderate, or aggressive, it's based on 2 characteristics. First is your asset allocation. How comfortable are you with the stock market? So the conservative retiree uses a 25% stock allocation. The moderate retiree uses a 50% stock allocation. And the aggressive retiree uses a 75% stock allocation. Then the other part of this is how willing are you to run out of money? Or what probability of success do you want for the financial plan? And because I do look at a variable spending strategy as well, we have to base the rule around this, not that you deplete your portfolio to 0, but that you want some sort of safety margin built in. So the conservative retiree wants a 95% chance that their real wealth is still at least 20% of its initial level by the 35th year of retirement. The moderate retiree seeks a 90% chance that their real wealth is at least 15% of its initial level by year 30. And the aggressive retiree only seeks an 80% chance that their real wealth is at least 10% of its initial level by year 25. The moderate retiree is the closest to the logic of the 4% rule, that you want a 90% chance for success, that you are willing to use a 50% stock allocation. Now the 4% rule does assume your wealth would drop to 0 by year 30 of retirement. And if you change the 15% to 0, that would increase the number, which I present here as a 2.29% withdrawal rate. That would be about a 2.6% withdrawal rate. But nonetheless, I think this idea of a safety margin is important because you're not going to want to just completely outlive your asset base in retirement. And that allows us to look at different strategies here. So fixed spending, 2% COLA, and inflation. Well, the inflation adjusted spending, again, a 2.29% withdrawal rate for the moderate retiree and a 3.41% withdrawal rate for an aggressive retiree. Now we can look at some of the different ways to manage the sequence risk as well. And those next 2 rows are about having a buffer asset. So again, that could be the cash value of permanent life insurance, or that could be the line of credit attached to a home equity conversion mortgage or a reverse mortgage. And I'm just looking at what are sustainable spending rates if you have 5 years of spending covered by a buffer asset. So of course, these withdrawal rates will be higher because you're not going to spend from the portfolio every year. And the rule I use is whenever your remaining assets drop below their initial level, if you still have buffer asset available, you'll spend from the buffer asset that year to try to give your portfolio a chance to recover. And we can see for the 2% COLA, the withdrawal rate went from 2.84% up to 3.47%. For the CPI adjusted spending, you go from 2.29% up to 2.75%. So buffer assets can have a big impact. We also can see the variable spending strategy. This is the Guyton and Klinger decision rules, which is probably the most famous variable spending strategy out there. But it calls for potential big cuts to spending. It has a mechanism built in not to take inflation adjustments for spending. And then it also has the capital preservation rule, which will call for occasional 10% permanent cuts to spending in retirement. So if you're able to make occasional 10% permanent cuts to spending, of course you can start with a higher distribution rate. And I do estimate, with this market environment, 3.9% for the moderate retiree. Now, one other point that we kind of have to work back and forth a little bit is, what about a partial annuity strategy? Since there's not a CPI adjusted SPIA, we can talk about this in context of the 2% COLA. So that SPIA rate, again, with the 2% COLA, 3.73%. Contrasting that, if I'm a moderate retiree, I'm looking at a 2.84% withdrawal rate. So if I put part of my assets into the annuity, that's going to lower the distribution rate needed even further from my remaining investments. But that might also give me more risk capacity. Now, if there's a market downturn, I have more spending protected. I might be willing to switch to a more aggressive approach. Well, if I went from moderate to aggressive with my remaining investments, we're at that 3.92% withdrawal rate. So blending the annuity at 3.73 and you may not go all the way to aggressive, but certainly with a more blended strategy with a partial annuity approach, you could get that withdrawal rate in the neighborhood of 3.7, 3.8%, somewhere in that range, much closer to the 4% rule of thumb, and that would give you that 2% cost of living adjustment still. So partial annuities can be very powerful. And any of these approaches, really, we can do a lot to help clients to move beyond just an investment-based strategy, which really requires people to be extra conservative because they have to self-manage the market risk and the longevity risk. But helping clients use a broader approach, incorporating insurance and actuarial science, annuities, life insurance, opens avenues to using buffer asset strategies, to using annuities, and to just having a more holistic or comprehensive approach. Withdrawal rates can be brought up to closer to, interest rates are so low today that it's tough to get up to 4% no matter what you do. But a broader strategy can help retirees in large part to get closer to what they think of as a reasonable income strategy, as opposed to the fact that because interest rates are so low, that 4% rule of thumb really doesn't apply in this type of market environment. And so let me go ahead and wrap up my comments there, and I think we'll have the opportunity of Tom and Kevin to have some questions from the audience.
Okay, Wade, thank you. Excuse me. Thank you, Wade. Really appreciate that. Got the video going there. My mind is turning. There's some great stuff in there, and I've followed you pretty religiously, and I love the term living benefit protection, and I love this buffer payment strategy. I have my first question, and we'll go to the field, is are there software programs that you recommend that might implement some of the strategies?
There are a few out there. One that's worthwhile to look at would be Income Discovery, and that's incomediscovery.com.
Okay.
And then also Curtis Cloak, who I think he does some webinars for NAFA as well. He's got that Retirement Next Gen software.
Yes, he does.
Yeah,
Okay.
either of those I think would be a good starting point.
All right, one of the questions we have for you, Wade, if you don't mind, is from Dennis, and he's got actually two questions, but the first one is, what is the best way to defend against sequence of return risk, living benefit riders in a VA, or cash bucket, assuming 6 to 12 months income needs?
So between those two options, I would definitely lean more towards like a good high quality variable annuity with a living benefit. In general, I'm not a real big fan of the cash bucket approach, but if you replace the cash bucket with one of these other buffer assets, like policy loans from life insurance or reverse mortgage line of credit, that can be powerful as well. But I tend to think risk pooling is such a powerful source of spending that investments simply can't provide, that it's really hard to think about a retirement income best practice without including some sort of risk pooling. And a variable annuity with a living benefit, it doesn't work exactly the same as an income annuity, but it is mortality credits and risk pooling, because it's the idea that those paying that rider who don't outlive the contract value of their assets help to provide the spending power to those who do outlive the contract value of their assets.
And I think you kind of answered his other question, which was a living benefits rider. I think this is where he's going with this, Dennis. 100 basis points for that versus the opportunity cost of a cash bucket. So I think you pretty much.
Yeah, well, maybe I can comment. Yeah, the issue of kind of the common complaint against the variable annuity would be that the fees are too high. But really, two ways to think about that. it's not really the fee drag necessarily that matters, but first, just how expensive is your retirement really means how much assets do you need to fund your retirement. And you need a lot more assets to fund your retirement if you're worried about outliving your money, but you're self-managing it by assuming you'll live a long time and get poor market returns.
Mm-hmm.
Having that risk pooling can let you fund your retirement with less assets. And then also you have the asset allocation issue. If having a living benefit in place helps you feel more comfortable with a higher stock allocation than otherwise, that can really go a long way towards offsetting the impact of the fee drag and not necessarily even reducing the net contract value relative to an unprotected portfolio with less fee drag, but also a lower stock allocation. So that's, I think the fee drag that people talk about with the variable annuities, not really how you should be thinking about it. It's really what's going to be the net impact on the assets you need to fund your retirement and on your legacy at the end. And for both of those, the fee drag's not negative in that regard.
Yeah, I couldn't agree with you more. I think it's the non-annuity world that likes to accentuate fee drag without understanding what you just said and guaranteed income, et cetera. Another question for you from Dawn. What is the process for refilling the buffer asset? Work longer, right?
Right. So I think in a lot of discussions, it may just be a distinction I make, but I do make a distinction between buffer assets and then like bucket approaches. And the idea of refilling, I would tend to apply towards a bucket approach where you have your bonds for your short-term expenses and your stocks for your long-term expenses. And then you have to have a rule for when do you refill, when do you move assets from your growth stock portfolio into your bond portfolio. And there's just to be clear about that, the worst way to do it is to automatically refill every year because that can actually increase sequence risk.
Yeah.
The approach that I do find works the best is if markets are down, you stop refilling, which can push you towards a more aggressive overall asset allocation. You only refill when your portfolio is looking to be in better shape. But with the buffer asset approach, that becomes more voluntary. You don't necessarily have to refill the way you refill a buffer asset would be you make loan payment. If it's the cash value of life insurance, you pay down the loan balance, and the same for a reverse mortgage. You voluntarily pay down the loan balance before you need to. Doing that as well, you can just, once markets recover, there's a number of different approaches there, but once it looks like your portfolio is getting to be back on track, you could make that voluntary refilling process to the buffer asset. But in general, it's not necessary with the buffer asset. And in general, the refilling concept applies much more towards a bucketing approach.
Well said. There's a great comment here, but I think you can expand on it. So someone is commenting on your talk and saying, thank you, this is excellent. Finally, someone addressing low interest rates, not using these unrealistic historical higher interest rates. I'm sure you see a lot of this, and then maybe you want to expand on that again.
Right. Yeah. One of my biggest pet peeves is still just how a lot of financial planning software bases their Monte Carlo simulations on the historical averages. And they're just pointing out, well, you don't know what's going to happen in the future, so you can't really do any better than what history says. But when they do that, that means they're assuming bond returns are going to fluctuate around 5 or 6% in the future. And that's completely unrealistic. Today's bond yield is a really good predictor of future bond returns. And today's bond yield suggests future bond returns are going to fluctuate around 1 to 2% in the future, not around 5 to 6% in the future. And so that has a big impact. If the 4% rule, when you run Monte Carlo simulations based on historical averages, it'll work about 95% of the time. But when you lower your interest rate assumptions to where we are today, you're going to be looking at more of a 60 to 70% chance for success. So it does have a huge impact. And it's also important because insurance companies live in the real world. You can't say, well, we don't know what bonds are going to be like, so let's, as an insurance company, assume bonds are going to be 5 or 6% and therefore offer a much higher payout rate on our annuity, because they have to invest those premiums, and they're not going to be getting 5 or 6% on the bonds that they can purchase today. It's just the investment world has to think the same way about that.
Yeah. And unfortunately, as many of us know, they don't. As Tom Hegna and Curtis Cloak and others say, actuarial science, that's what the insurance companies use. And I wish more people would do that. I think you'd see a lot less people upset over the last month or two if they had. I want a reminder, we've still got some questions coming in, but if you have some other questions, please use the Q&A segment if you're on Zoom. Another question for you, Wade, if you don't mind, comes from Stanley. Which would you consider the better product to create a buffer asset, index UL or a limited pay whole life policy from a mutual company?
So thus far, I'm a lot more comfortable with a limited pay whole life insurance policy from a mutual company. That's mainly what I use in the research I do. And in doing that research, I became so compelled by the findings that I got myself a big whole life policy for that. Index UL, because I am personally from the investments world, so I'm having to learn about life insurance as I go along. And so the index UL can be more complicated. And I think, I guess there's a lot of issues with how it's illustrated and whether the illustration can really hold. If you've got a conservative enough illustration, index UL should also work fine, but there's a lot more risks and caveats to it. So just personally, I'm a lot more comfortable with the guarantees provided in a whole life policy.
Yeah, our agency sells both, but I can tell people my biggest concern with the index UL is some of the assumptions that are still out there, even after some of these rules have been passed, where the guarantees and the dividends of the mutual companies tends to be a little more consistent. At least that would be my personal view. Again, I want to remind everybody that we've had another thing come in about, can I get access to some of this information? Because if you're like me, it went over my head. But yes, if you go to belong.nafa.org/town halls, you'll be able to see not only this webinar, but all our series of webinars in regards to this. So please feel free to do that and check out the NAFA website. Are there any more questions? I know one thing, I spend conservatively. I'm going to try and see if we can use that motto here at home a little bit better. But I do love that term. And then the other thing I really loved, Wade, was the cost of spending spread on bonds versus annuities. That was very, very, I really like that slide. So I got a feeling I'm going to be using that one if you don't mind. Let's see, it looks like we might have had a couple more questions. Hold on. Okay, here we go. From Craig. You are assuming buffer asset does not have a cost. If the cash value of life insurance cost XXX and you were to add that value to asset value, then you could have lower withdrawal rate, parentheses, better chance of outliving money or less risk. Please comment on this.
Yes, so I would say this is not true. I actually tend to assume like realistic costs for the buffer asset. Both in the context of the reverse mortgage, I cover this all in my book on reverse mortgages, and I assume full retail pricing on the reverse mortgage and the full costs. On the whole life insurance side, actually just this last week or two, we've had a new white paper come out on the New York Life Center for Retirement Income at the American College, where I do these simulations. And to make sure I'm fair about this, I start with I think sometimes I use 35-year-olds, sometimes 40-year-olds. I think that paper did use a 40-year-old who's decided they need some life insurance. And so they're looking at, should they buy term and invest the difference? Or should they get permanent life insurance, thinking ahead towards retirement income? And because the premiums on permanent insurance are so much higher than term insurance, they have less in their investments at retirement. And so I fully incorporate that into all the analysis and still find that effectively incorporating permanent life insurance, it's a much more efficient approach in terms of the same asset base, the same savings. By positioning some of that into insurance and less into investments, you can support more spending and more legacy at the end. And that is incorporating costs. The policy loans have an interest rate attached to them. And just the reverse mortgage has an interest rate. The idea is legacy So for a reverse mortgage, legacy would be what's left in your investments plus the value of your home minus the loan balance due. For life insurance as a buffer asset, your legacy is what's left in your investments plus the death benefit on the policy minus the loan balance due. And the idea and what drives the findings of the research is there's all these synergies with sequence of returns risk, that by being able to help preserve your portfolio, the gains to your portfolio are so huge that once you subtract yes, the buffer assets are expensive, but once you subtract the costs, you can still have a positive net outcome, that the gains in the portfolio are greater than the costs of the buffer asset. And so you have a better outcome at the end. And I do try to really incorporate all those costs to demonstrate how the gains can exceed the costs when the costs are fully incorporated into the analysis.
Okay. This comes in from Rashad. How do you answer a client that feels the fees may be too high for variable life insurance, especially after you explain the fees are front loaded and the tax benefits are greater?
Yeah, so for the variable life insurance, as I've been learning about life insurance, I've gotten the most comfortable with whole life insurance. I don't have too much of a working knowledge about the specifics of variable life policies, so I can't really comment on that question.
Yeah, I mean, Rashad, I'd be more than happy to take that offline, even though I'm not, I'm not a big variable life producer myself, but obviously the client's got to know that they're taking on a lot more risk in that scenario. Anonymous attendee says, what about universal life? I think you kind of touched on that before. As long as they understand that the risk is shifting to the insured.
So
right?
they're using a conservative enough kind of illustration.
Right. Another question from our friend Dennis. What is your opinion of HECM purchase as downsizing strategy in retirement?
So this would be a HECM, I guess they mean the HECM for purchase program, which is
That's what I thought,
using
right?
a reverse mortgage to purchase a new home. And yeah, so I've run simulations on all that, using a reverse mortgage to refinance a traditional mortgage, or using the HECM for purchase if you're purchasing a new home. And that could also be a part of downsizing if you're buying a less expensive home. And I find it works, that again, it's helping your investment portfolio and helping to lower the distribution need from your investment portfolio. And the benefits there more than offset the costs, so that you can get a better net outcome in terms of spending and legacy if you're using that HECM for purchase strategy.
Dennis, I hope that was what you were looking for. Anyway, if we're getting near the end of our time, but in case some people are still typing in some questions, why don't you take a minute or two to plug the RICP if you don't mind.
Oh, well, thanks. Right. So the Retirement Income Certified Professional Program at the American College, it's a 3-course designation. It's all available online, and on May 1st, it's going to be in a completely new learning management system and updated fully for the Secure Act and so forth. And it's the 3 courses that walk you through all the steps of building a retirement income plan and looking at all the associated kind of things to be thought about: spending rates from investments, annuities, life insurance, Social Security claiming strategies, long-term care planning, Medicare planning, and on, just to really help the clients have a complete picture of how to think about their retirement income.
I had one other question here, and I hope I don't mess up what she was looking for. It was from Wendy, but I think she was worried about what about the insurance companies? People are worried about the insurance companies paying the guarantees. I'm not quite clear where she was going with that. I tried to get back to her, but any comment on the viabilities of insurance companies in these times?
Yeah, so I do speak to a lot of groups that are more skeptical of insurance in general, and the 2 biggest arguments they make are the fees, and then this idea that the insurance company will default on the promises, so they don't have all that much value anyway. And of course, there's nothing that's 100% certain, but I think those kinds of concerns are often getting overstated. The insurance companies are highly regulated. They're really not investing in the stock market. The very high quality, the assets in their general accounts with sufficient reserves. So while the risk is not zero, it can definitely be overstated quickly, and people can just take action to diversify between different companies and so forth. Now, what could hit the insurance company would be a massive widespread defaulting on bonds, but that's going to be a really catastrophic outcome for the economy no matter what. And it's not really anything you can plan for with financial strategies. So I do think those concerns are overstated. And in terms of the current, what's going on right now, yeah, low interest rates are challenging for the insurance companies, but they should still, manage what they have on their books already. They may have to adjust new policies that they offer and so forth. But they should be able to manage their book of business at the present.
I agree. They can't let me down now. Been doing this almost 35 years, and I think we're in pretty good shape. The last one, and it's really not a question, but it's a testimonial from Dennis, who asked a couple of the earlier questions, says, I'm a current RICP student, and it's a great program. So there, how's that for a...
Okay, thanks, Dennis. Appreciate it.
Wade, again, on behalf of the NAIFA Executive Committee and the NAIFA Board of Trustees and all of NAIFA, we want to thank you for taking time out of your schedule today and away from homeschooling and all that's going on in our crazy world to spend some time with us. I know I found it informative, and I'm getting texts and everything else as well that are saying that they learned a lot. So thank you for your time. We really do appreciate it. Before we close, I just want to remind everybody we have 2 more great presentations next week in the NAIFA Town Hall. We have Joe Jordan on Monday, the author of Living a Life of Significance. I think everyone, if you haven't heard of Joe Jordan, you want to be there. And even if you have, I think Joe can always make you put a positive spin on any kind of day. And then speaking of positive spins, on Thursday, Scotty Brennan, former MDRT president, recipient of the 2016 John Newton Russell Award winner, and Mr. Confident, Mr. Positive himself will be joining us with some anecdotes on how to get through these difficult times. I want to thank all of you for taking the time to be with us today, and I wish you a great day and a good weekend, and stay safe, and please know that NAIFA's got your back. Have a great day.